Good afternoon, everyone. Today I'm chatting with Mike McGlone from Bloomberg. In today's interview, we get into commodities. We talk about gold and what you should be watching if you're bullish on gold and want to see it go higher. We also get into copper, what Mike thinks is in store for the future of copper prices. And we talk Bitcoin, of which Mike has gotten some pretty bold calls right on Bitcoin since I started talking to him a few years ago. Don't miss the Rule Symposium for Natural Resource Investing happening July 7th in Boca Raton. If you can't make it in person, that's not a problem. You can get your ticket to watch live online or on demand. We'll be there with the deep dive, so if you make it out to Boca, come say hi at our booth. If you want to sign up, click on the link in the description to get your pass. All right, everybody, enjoy the interview. Mike, it's good to see you again.
Well, hello. Thanks for having me back.
So since we last spoke, gold continues to, outperform is one way to put it. We've got Bitcoin is also showing some level of strength. Copper is seemingly showing some strength too. I know that it may not be quite as bullish as what you originally forecasted, but it's still showing tremendous strength. So let's start with gold. When you look at the gold market right now, what are the things you're thinking about? What's moving the price, and where can we go from here?
Well, I enjoy starting there because my head of agriculture, we had a call this morning. We were talking about corn, soybeans, and wheat. He says, "All I see you writing about lately is corn and is gold and Bitcoin." I said, "Well, because they're going up." At least I have bull markets there, and that's the key thing. Is I think gold is the most significant bull market really on the planet, and the sustainability is very getting scary. Meaning, up almost 30% on the year as we speaking on June 3rd is a scary proposition for if it continues because it's the highest ever on a month-end basis versus Bloomberg Commodity Index. It's basically a 100 ratio versus silver. It's never close above 93 on the end of the year basis. It's just expensive versus everything except one key thing. The U.S. stock market, the S&P 500. So that to me is a key driver for gold. Obviously, we know what's the main underlying drivers are. Central banks are buying. The latest I heard from the World Gold Council, who does really good data on this, is Poland has been a lead buyer. Not messing with that. And people. It's all started with Russia's and China's unlimited friendship in 2022. That shifted the world, and it's still building gold. So I think the thing I'm worried about gold now is gold has an issue if the U.S. stock market keeps going up, because I think that's the key thing that really kicked gold in was people are starting to worry about U.S. interest rates going down and stock, that great wealth creation machine, having a bit of a blip, and it did, but that was it, a bit of a blip. Now looking forward, if stocks end the year up 10%, which is the consensus, gold up 30% might not make a lot of sense, except in an inflationary environment. And the Fed's not going to be easing in that environment, which means it'll be pushing back in inflation. The key thing I'm worried about now that I think gold is predicting is a bit of a pullback, retracement of S&P 500's total return since the end of 2019, which is phenomenal. This pull back 10, 20% of that, which would mean nothing in the big picture, but it have deflationary underleans. And that to me is what gold's priced in. So I look at gold stock between 3,000 and 3,500 at the moment, and getting above 3,500 will probably mean U.S. stock market ending the year down.
So you, basically, if I'm understanding this correctly, you are of the mindset that there's a little bit of a negative correlation between, we'll say, the S&P and gold is sort of what you're forecasting?
Right now there is, yeah. Sometimes historically gold is zero correlation to S&P 500. Sometimes it's negative, sometimes it's positive. Now it's acting more like an S&P 500 put. Obviously, without time decay, it's way outperforming S&P 500. So I'm extrapolating into the future what's going to matter for gold this year. What gets it above 3,500 an ounce? It doesn't make a lot of sense to me to stay much above that level with the U.S. stock market strong, the Fed tightening, and the global economy doing fine. That's more of it's to me right now. It's showing that with that gold crude oil ratio breaking out, I mean crude going down and gold going up. That's a bit of a global deflationary event. Makes sense on the back of tariffs. Copper's kind of stuck in the middle. But that's why I'm looking forward to is I just look at the key thing now is what we widely anticipate seldom occurs, according to Benjamin Disraeli. And it's completely anticipated the U.S. stock market is going to be up 10%. So it better be up 10% this year. And I think the risks are it's not. It doesn't. It goes down. And gold, I think, is sniffing that out.
Okay. Bitcoin. You've been bullish Bitcoin. You've been bearish Bitcoin. That's one thing I enjoy about your commentary is that it seems like most of the people we talk to, it's either Bitcoin can only go up or it can only go down. you seem to view it more of the lens of a trader who sees there's going to be ups, there's going to be downs. What's your read on Bitcoin right now?
It's in a selling when you're supposed to be selling when they're yelling mode. I think Bitcoin's very expensive, above 100,000. I sense excessive hubris and bullishness. And to me, it's more like a commodity that has, yeah, it's supposed to have unlimited supply, but it has right now unlimited speculation and excesses. And its competitors, there's only 16 million other cryptocurrencies. There was one Bitcoin in 2009. Now there's, or cryptocurrency, now there's just unlimited supply. So I look at it more as a commodity on the screen that's too expensive. And this narrative now, find very disconcerting that corporations are adding to its treasuries, yet it has a volatility that trades 3 times that of gold, and the S&P 500 could easily drop 40% on a first standard deviation movement on the year. Its volatility is 40% and mean nothing. So I find it's systematic risk of this asset to have to keep going higher is really getting disconcerting to me. So I can't be bullish these levels. And also a key thing that's keeping me bearish on Bitcoin and defensive, I would say, just don't want to join this rally, certainly not right about it, is what got me bullish in 2020 when Michael Saylor jumped in. It was $10,000, and President Trump hated it. Now we have the exact opposite. President Trump's tilted, and the Trump administration loves it. They're on board, and look at me. I got rich buying Bitcoin. You can too. Be careful with that. This is what I'm just saying. You're just not supposed to get too excited around 100,000. So the key thing that's also is keeping me bearish is that Bitcoin to gold ratio. You took the ounces of gold to one Bitcoin right now is about 31, 32. The peak was 40. The level you see right now on the screen is about 32 ounces of gold per one Bitcoin. Was first traded in 2021. That's not good because this ratio has a very high correlation with beta. The stock market has kept going up, and this ratio is flatlined. So I still bullish gold. I still think gold's going to outperform Bitcoin, particularly in an environment where U.S. stock market volatility is increasing, potentially stock market's declining, and potential the world's tilting towards a global recession, which is clearly the case. You've seen a lot of commodities. Is like I said, gold at the highest ever versus Bloomberg Commodity Index is only last time that happened was 2020, right during that global recession. So I'm very concerned about Bitcoin. I think it can easily drop a zero. I wrote that same exact piece in 2018 when it bumped around 10,000. And that could drop to zero. The low was 3,000. So yes, I was wrong. It did have a 70% correction. So I can easily get back. I wrote recently, just published, I can easily get down to 40,000. And my premise for that is if U.S. stock market just backs up a little bit, maybe from right now, of course, from 6,000 to 4,000 S&P 500. That's the base case from Bloomberg Intelligence in a recession. Sure, it's not priced in, but that's where the optionality is. So I'll end with this. I think Bitcoin's reached a status now that it's taken on that inordinate burden of beta of the U.S. stock market to keep appreciating to lift all boats. Because if Bitcoin drops, it signals a bit of weakness of the Trump administration, a bit of failure. All these new entries that are getting in are going to start getting hit and hit stops. It's an asset that must go up and means the risks are down. So I just can't, I'm so scared of it. And I look at over things like the Bitcoin to gold ratio overlay with Shiba Inu, with Dogecoin, it's the same chart. And Dogecoin is a joke. It's worth $29 billion. These are the excesses that will need to be purged. I think at least some of them before I can get bullish the space again. And it only can sustain 16 million cryptocurrencies with jokes that trade at 29 billion a market cap when you have the U.S. stock market running the highest in 100 years versus GDP and versus rest of the world. Now, when that gives up, I didn't say if, it's going to be a matter of time when it gives up some of that. It started a little bit this year. Then this whole crypto space, I think, will get purged, and then we'll have a nice bottom, and there'll be time to buy it again. But here, this is just too risky.
Now, I got to ask you about copper. Copper seems to be catching a little bit of a bid lately. We obviously see Robert Friedland coming out constantly saying really bullish things on copper, like it's basically going to go parabolic as the world runs out. I'm curious here, where do you see copper heading over the next couple of years?
First of all, I think it put in pretty good peak this year at $5.37 a pound, based on that massive disparity between LME, CME, and LME traded copper. It got to almost 20%, the highest ever. Futures go back to the 80s in this. And that's usually how you put in a long-term peak. Now it's looking great on the charts. Everything's ticking higher. Looks great. Thing is, one thing I just will be publishing tomorrow on June 4th is open interest has collapsed, meaning that futures traders are not buying into this. They're not getting it. Managed money net positions are not overweight long, which I would like to see for a sign of a peak. So that's give it here nor there. But typically, copper is not in any type of bull market. When you see massive declining open interest, it's dropped 30% on average for LME and CME over a 1 year basis. That's a sign of short covering. It's typically not a good sign of a healthy bull market. Then you look over to the rest of the world. Why is copper distorted? Well, the US price is up 20%. The price in Europe's up 10% this year. Why? Because of tariffs. Is that going to increase the demand for copper? No. What happens with higher prices? It's going to decrease demand, increase supply. Now, it's a much more of a lag, but the world facing U.S. tariffs of about 15% from the world's largest importer, the U.S., is definitely not a good sign for copper. Crude oil seems to get that. Copper doesn't. So I'm really worried copper is going to do what it normally does and do what our Bloomberg intelligence model says the fair value is closer to 4 right now versus on the screen, it's 484. And it's going to do what it normally does, revert backwards. So I think there's also a significant burden, just like Bitcoin and copper, to keep going up, or it's going to be a trickle down part of the deflation. So we're seeing, here's a deflation I see certainly happening. Gold taking off. Some people call it inflation, but it's deflation in this case. Chinese bond yields collapsing right now, 1.71% in the 10-year note yield. That's almost 300 basis points below the U.S. Chinese bond yields collapsing. Most of the rest of the world facing recession. And what's going to change? Well, okay, they're only going to pull back in U.S. tariffs if the U.S. stock market goes down, because that's the only thing that's hold back Trump. So I see copper as a risk. It's much higher risk of going back down towards 4 than staying above 5. And the key thing I think about its copper is it has that same, that it's a nail to beta's hammer. If beta starts going down, I mean, if U.S. stock market just, instead of going up 10% this year, goes down 10%, which I think is my base case, copper is going to be one of the first things to get hit, along with Bitcoin. Everything's so linked now. It's unfortunate. Fundamental, but like I said, our fair value model says it's closer to 4 rather than where it is right now, 484.
Now, you mentioned bond yields, and I got to ask you, how important is the Japanese bond market to the global economy, and what are your thoughts on it?
It used to be for the carry trade. I think it's less so now. It's really sort of the shorter end. So right now we have Japanese JGBs at 1.5%. I remember trading them. They were 3% and going downward. The significance is they're finally coming out of that deflation. But I like to tilt over to what happens with Japan. To me, is signaling what's happening in China. We're all turning Japanese, and China's doing it right now. Chinese government bonds right now 1.7% versus Japan at 1.5%. It's just catching up. China is the most significant economy in the planet that's going into a severe deflationary recession. It's really normal for a rapidly advancing emerging market that grew too fast, has no auto credit, no natural check and balance like we do in the West. And it's just a massive machine for exporting deflation. And the rest of the world's not even pushed back in them. So to me, that's the key thing to think about with bond yields. Japan has come out of that. It took them 30 years. I traded JGBs in the 90s, and everybody I remember I was doing hedging and trading. Everybody I spoke to wanted to get short them because they thought yields going up, and they were wrong. I think that's where China's going. The significance is, look what's happened is the U.S. How much longer can U.S. yields stay this much high versus the significant exporters on the planet, China, Japan, and Germany? The average yields are around 2%, 10-year notes. So to me, that's the risk. If copper drops, it signals the U.S. yields are going to go that way. Key thing for that is the stock market to go down. And what prevents all this from happening? The U.S. stock market has to stay lofty. So I see what you're seeing there by mentioning bond yields. I have to mention government bond yields in China and Japan. The rest of the world is showing from bond yields deflationary forces. And the key thing that's holding that back from a global recession, which is facing U.S. tariffs now, is the U.S. stock market has to stay up. And that's why I think risks are down. That's why I'm worried about Bitcoin and copper, because if they kick down, that's a flood. That's a complete deflationary domino, which to me is normal. And that's, it's not my view, historically is normal after you get big inflationary pumps, which we did.
I take it you've heard of the taco trade, which is the Trump always chickens out trade. I kind of look at all this tariff talk and I kind of see what's happening in the stock market and what's happening in the bond market. And I can't help but think that the smart money just doesn't think that really this tariff stuff's actually going to play out. Is that a fair assessment?
Well, I have to push back you a little bit there. First of all, that's one thing I've said. Love him or hate him, this man is one of the most significant business clever sharks on the planet, and he's hired some of the best, and they're running our government. Like, if the rest of the world, for certainly President Xi in China, who's Danny Minton Beddoes of the editor economist described as an economic incompetent. You have to have eyes wide open, say, oh boy, what are we doing now? Because this is everything I've read from No Trade is Free by Robert Lighthizer and by We're at War with Ourselves by General McMaster is happening. And I would say, do not underestimate this human being who's running this government, and particularly what's happened with Doge. So I think our Bloomberg economics expect the average tariff in this country is going to jump up to 15%. We're not there yet, but the only reason he pushed back is the stock market went down. You have to see that correlation there. We are so high, so elevated now. We're close to the end game that everything that's being driven is if stock market goes down, he'll pull back in tariffs. If it goes up, he'll push more tariffs. It's just the way we are right now. Thank God we're stable. But I would suggest people do not underestimate this person who was in exile for four years, emboldened about tariffs decades ago, and now it's got a second chance. So when I heard that taco, I loved it. But there's one thing about this man, he ain't a chicken. It's just he's not. He's one of the significant business sharks. Love him or hate him, but he's running his government, and you just got to. I had a Middle East colleague ask me about him. I said he's the king. Until he's not, you got to respect what he wants. And I look at simply from a market standpoint, this is what it means for markets. And it would be wonderful if we can get through this period of discombobulation, which he's creating, without the US stock market just reverting a little bit from the 100-year high versus GDP in the rest of the world. That would be wonderful. So far, we're doing it. But you look at the MSCI ex-US index, it's up 17%, and S&P 500 is basically flat.
So, Mike, if I'm following here, it's like it does sound like you're essentially saying that the taco trade does work, though, because my understanding, if I'm following what you're saying correctly, is that we can't have the stock market crash because everything's so tied to the U.S. equities market. So when the tariff talk does get a little bit hot, and we're talking about, say, 130% tariffs against China, we know that that rhetoric isn't actually real because it would ultimately crash the market. So
It's accomplishing the goal. The point is what happens with tariffs. Just remember why your average CEO based in the U.S. would close a factory, which is completely politically incorrect. And offshore production is for one reason: profits. According to Gina Martin Adams, cost of goods sold in S&P 500 is about 43% from imports. I mean, we're going to crush profits, and we want to see profit margins going lower. So the great wealth creation machine in the US was great. And it's just how much better is it going to get? And the world's they're selling rallies. I think they're going to continue to do that. The point I'm making, though, is the chicking out thing just is completely wrong because this is part of his negotiating tactics. He's getting what he wants. Bottom line, by chickening out, call him a chicken. He'll probably say, yeah, great. I got tariffs up to 15%. No one in the entire history of the world has done this in this country except Smoot Hawley. But by the way, the U.S. was a net exporter then. This is phenomenal. We have 100-year events happening, and the stock market's hanging there like wonderfully. But gold's, I think, figuring out. So to me, that's the thing about Taco and Mr. Trump is a chicken is not the right word for this human being. An emboldened president who's now leading the free world is probably better, and he's getting what he wants, and at least until midterms. So here's the way I look at it in long term. Either this is going to fail and we get that great recession, which we're way overdue for. I mean, we didn't get it in 2023. We're way overdue for the stock market to create the recession. Same thing that happened in 1929 in the US, 1989 in Japan, this somewhat 1999 in the US. This stock market goes down, creates recession. We're way overdue for that. But if he succeeds, what the rest of the world is going to face this for centuries. It's like, sorry, we're done. This is the new mercantilism. And by the way, if you want access to U.S. market, you're going to have to pay for it. Now, that obviously is just the way it is. It's going to be. And that's what he started. And so far it's working on it and just giving people little delays. But then you touch the key thing is I don't think there's going to be anything that's going to stop a little bit of normal reversion in the stock market when it gets going. It just always has happened. To stay at 2 times GDP has never happened historically. Well, maybe it's the first. That would be great. The longer we can do it, the better.
Do you think that Trump wants a cheaper US dollar?
Yes. Well, he won't say it, but if you want a balanced trade, that's a prerequisite without saying it. It's just silly to expect anything other than that. But that's the key thing that's happening there. So the Bloomberg Dollar Spot Index is down 7% this year. Obviously, that's boosting things like gold and copper. And the S&P 500 is up 2%. Typically, they've been on the same trajectory since the bottom 2009. So dollar weakness is that preempting the weaker stock market? But they have not diverged like that forever. But the one thing that's really diverged is gold going up, dollar and U.S. stock markets versus the rest of the world going down. I think that's going to continue.
Have you put out any forecasts for where you think that the price of gold could be heading?
Yes. Well, I think it goes to 4,000 if Bloomberg Economics is. Well, here's a scenario. Let's play some scenarios. If Bloomberg Economics is right and we get this recession that didn't come in 2023, which I was wrong on, I think we're overdue for. S&P 500 fair value is around 4,000. And that's easy. I think that's a good way to get gold and S&P 500, that fair value back to 1-to-1, which is historically what it was, and gets gold towards 4,000. The thing is, right now, gold's front running that. Or is it failing? I think it's front running. And yet the stock market says, no, we're good. We're going to keep going up until something stops it. It's a thing that would get it below 3,000. Say, let's put it this way. Last year's high in gold was 2,800. And here we are right now at 3,300, 3,350. So it's doing pretty well. It's already priced in a lot of bad stuff, and it's already got a lot of oomph going for it. So it's an extended bull market. To get it back below 3,000, I think would mean U.S. stock market has to keep going. It has to have investors in U.S. say, those ones who have really started dumping into gold ETFs for 4 years. We've had outflows this year, significant inflows, about 6%. I think that's about 5 million ounces. They've shifted into gold. Obviously, they're buying Bitcoin too. But for get them to start giving up on gold means that they have to have that alternative that there's, when beta goes up, everybody's got involved, and that's still the case. And that to me is why that's the optionality, the risk here right now is you can buy into this and maybe get that 10% that people are expecting in the stock market. Or the big trade is if stock market goes down this year and those deflationary forces you've seen in China and crude oil accelerate downward.
When you say the $4,000 price target on gold, are you looking at this year?
Oh yeah. Well, if and it's there's a key catalyst. I mean, key if statement there is if the U.S. stock market goes down, starts trickling lower. It's kind of a prerequisite now because it's just the way it usually trades, and it's trading that way, and it's a bit of a put. Gold's a bit of a put in the stock market, but if it's stock market stays strong, Fed's not going to ease. It's less likely they're going to ease. And there's just less demand for the rock to keep beating the stocks. I mean, there's been good demand when we had that first quarter issue and with, what's happening with U.S. debt and our new president. But if stocks stay stalwart, it's less reason to be buying the rock.
I don't know if this is a fair idea, but it almost kind of seems in some ways like the stock market's dependent on NVIDIA right now, which is dependent on these AI models using massive and massive and massive data centers. But that sounds to me like a scary proposition because technology is inherently deflationary. It gets better over time. The idea, and look, I'm not I'm I'm obviously not an AI programmer or anything, but it seems counterintuitive to think that we're going to need more and more chips like at this scale as these models progress.
I think you nailed it. It's from a great Canadian, Jeff Booth, who wrote the book, The Price of Tomorrow, is technology is exceptionally deflationary and it's accelerating. I see that in commodities everywhere, particularly in the grains and crude oil. And there's a little bit of electrification demand for copper as the offset, but that's the key thing to think about when you're buying an S&P 500 index. You're basically buying almost 40% of it is the Mag 7. It means, okay, great. And where are they going to face competition from? I mean, why buy Tesla now when you can buy BYD? It's like half the valuation, make better cars. They have much better sales, and they're proliferating around the world. They've stolen it, of piggybacking the technology, maybe not stolen. Just this is what's happening. Tesla's being Tesla'd. and so it's gonna all it's gonna happen is the technology that's coming out of China is shocking. Humanoid robots, and I think people who underestimate these delayed deflationary forces for our very elevated U.S. equities versus the rest of the world's equities are very cheap, are way underestimating how the target for profits for the Mag 7 are right now. Companies will figure it out, and they are fast. So I'm very concerned about that macro. I only stick for the macro for stocks. Um, And that's why I think part of the reason we're seeing that. The key thing I used to like watching, my colleague Gina Martin Adams turned me on to, is watching the S&P 500 divided by the MSCI ex-US index. Now it's been going up. That ratio has been going up from basically below one, about 1 to 1. It's stuck around for almost 40 years. In 2013, it broke up and topped up to about 2 to 1. Now it's starting to roll back over. The rest of the world's catching up. U.S. exceptionalist and way expensive, but overlaid with that is U.S. dollar. Same chart, and they're both ticking down. I think they're just getting started. And to me, that is part of the rest of the world gaining on that. Yeah, the U.S. led the way, but getting to the most expensive market cap versus the rest of the world ever is just a target for the rest of the world to catch up.
Well, Mike, I really appreciate you hopping on here today. For our audience, if they want more of your commentary, where can they go to?
Well, on your show, thank you for that. On the Bloomberg, on Twitter at Mike McGlone 11, and on LinkedIn, Mike McGlone, Senior Commodities Bloomberg Strategist. And if people want to, they can reach out. I'm happy to add them to my distribution list. And thank you for having me on.
Thank you for hopping on. Every time we have you on, the views are outstanding. I was telling you before, you are one of our top guests. So we always appreciate you hopping on here. And please keep coming on here and sharing your insights. They're very valuable for our audience.
Honored, and thank you. And thank you to your audience, partly because I just say it. Most of them are doers. Most of you are doers, and I respect that. I used to do it, and I say it better than I do it. I used to have hair. You can see that.
Thanks for hopping on,
Okay,
Mike.
thanks.
All right, everybody. Thank you for watching. If you enjoyed this video, please smash that like button, subscribe, and ring that notification bell. Guys, if there's stories you want us to cover or guests you want us to have on, please let us know in the comments section. Thanks for watching, everyone.